We have our guest to discuss that, Mr. Shachindra Nath of UGRO Capital. Well, there are other company-specific triggers as well, but I'll come later on that one, Shachindra ji. Afternoon, thank you so much for your time. The one point which stood out in my observation was the commentary from RBI to NBFC community, saying that they need to diversify their borrowing mix and reduce their dependence on banks. Now, we've been talking about it with you off and on, and you've been talking about it, practicing this in your own company, and also generally the need for NBFC space to somehow go ahead and diversify the borrowing mix. Now emphasis from regulator also coming in over there. What are your observations?
Thank you, Ajay. I think so. There are two parts to this. Part one is that bank credit to NBFC has grown disproportionately. But what is missing is that has grown disproportionately to large NBFC. 85% of the bank credit to NBFC still belongs to AAA and AA rated NBFCs, which have other means of borrowing as well. Since the crisis of ILFS and DHFL, for A-rated NBFC, which actually do the most of the inclusion work and the impact financing of MSME and others, the source of other financing is very, very limited. Obviously, the co-lending came as a much bigger breather to that. But while there is interconnectedness, the systematic risk is there, but that risk is only limited to 5 or 10 of large NBFC. So what is required is regulation to be designed in a function wherein banks are motivated to expand the credit to NBFC across the universe of rating agency. If you remember, one of the ways was when the TLTRO was brought in by the government during the liquidity crisis. The bank credit to NBFC actually expanded to the A-rated NBFC quite aggressively. If we really want to achieve the target of priority sector lending, the MSME, the other segment of agri and others, that job is still done by younger, nimble, data-driven, technology-driven NBFC, which is making an hard effort to go bottom of the pyramid. That is my view.
Right. So, this is, of course, a very ongoing challenge for NBFCs. I want to understand which NBFCs will actually be able to succeed in efficiently, diversifying their borrowing mix and also ensuring that the borrowing costs also remain on the lower side or at least in control compared to their overall yields.
So as I said, that there are two types of NBFC. There are NBFC wherein bank is motivated to lend because of their name and the size and because of their parentage. And NBFCs like UGRO, which are self-funded, completely institutionally owned, wherein from day one we have made a conscious effort to diversify our liability sources. And that is the reason why we became one of the largest co-lending partners to the bank, because we felt that the power of the capital and the trust of the public to keep their monies with the banks, the capacity to reach to the bottom line end customer into MSME, we will build that capability and we'll bring this partnership, which is a difficult journey because there are two different type of institutions you have to bring together to underwrite the credit. But if you constantly focus on that, today roughly around 50% of our 8,000 plus crore book is under co-lending. You will succeed. Second, while the public market, especially the mutual fund market and the debt capital market for lower rated NBFCs more or less still continue to remain shut, but there is a massive source of other financing. So today, of our total borrowing, only 38% is bank. Then we have global DFIs, likes of FMO, IFU, which became our shareholder, most of the impact fund, and next 2 quarters, you'll see almost every global development financial institution and multilateral agency would be a lender to us. So a combination of off-balance sheet, on-balance sheet, and a diverse source of liability is what would make sure that we are not highly dependent upon the bank. We are not highly dependent upon one segment, but we continue to the journey of maintaining the growth and delivering credit to the deserving sector. Having said that, I think so it is also clear that in India, NBFC's dependence on banks would not go away. What is needed that banks' concentration risk on certain large names, and especially the PSU-driven NBFCs, should be diversified across all rating bands.
Shachindra, I also want to talk about a bit, if you can, about the news on the exchanges about your fundraising plans, and the nod for NCDs. Talk about this particular fundraise and overall too, how you are aiming at. I saw some news bit a while back as well, raising some money from an overseas body. How are you going about diversifying, and how is the likelihood of the borrowing mix change in current versus say 1 year from now?
Yeah. So I think so. It just so happened that on one side, the trends report said that, and the RBI commentary is saying that NBFC should reduce their dependence on the bank. Our dependence have always been moderate, not very high. But from day one, since our inception in last 5 years, we have been constantly building our profile and showcasing the impact which we create. And incidentally, all of that effort is now fructifying. So we recently did a transaction with FMO wherein they put 250 crore as a debt transaction. Another global multilateral is would be putting, which got announced a few days back. We have done already 4 public debt issue, and we'll be doing 1 more soon. So all of that is now fructifying. In next year or so, we don't think so that our growth would get sacrificed in any fashion because of banks reduced NBFC. For our size, I think so still our aggregate exposure with each bank is very less. Second, our ability to increase our funnel on the co-lending side, because we have 9 banks, some of them are smaller, we can increase that. And now we are attracting both public market debt, global DFIs, all kind of instrument. So I think so we, for our size expectation and what we want to deliver in the market, we are fairly set.
Shachindra, I know you are in silent period, so can't talk much about company result because results are expected in Jan, but all good on business momentum front, just a color.
Yeah, this is one thing we're fairly proud ourselves that first, we publicly put a very, very ambitious target to ourselves. The reason why we do, while we have been advised that I should not be doing it, but the reason why we do it, because we want to aspire to build a large institution. And once you put that number out, then the whole system, the management, the infrastructure actually try achieving that. So we put that self-pressure on to ourselves to deliver. So whatever we have projected, we are more or less on target for that.
All right. Good luck. Thanks very much for joining us, and best wishes for you and the team to achieve those. We'll speak to you around the results once again.